try and finish up this section, and then I'll see. Okay, what is up with the internet? All right. We've done national income accounting, uses and misuses of GDP. And then let me try and finish up. So did we talk about GDP per capita GDP? GDP per capita?
No, please.
Andrew?
No, sir.
I have to wait.
No, they didn't.
Okay, so we are. I should start
We
from
were
there.
explaining what
we are starting.
GDP was,
Okay.
and then GDP
Okay.
versus GNP.
GDP versus GNP.
Yes.
No, it wasn't explained, but you said in the next class, that's where we're going to start from. We're going to start from GDP versus GNP.
Okay. All right, let me start. Let me mute everybody, and then. All right, so welcome to this class, the last bit of the slides on macro, for this particular slides. So we're starting from uses and misuses of GDP. We talked about measuring GDP. I think that we did talk about that. I can just take a quick step back. And if we didn't, please, you let me know. Okay. We talked about this one, if I remember. So what is national income accounting? Yes, class rep, you can unmute yourself if something is not clear. And then the three main approaches to the calculation of GDP. And so how do you measure GDP? Measuring GDP, we did talk about this one, I think.
The last class, we stopped at GDP versus GNP. You said
GDP.
That's where we'll start from in our next class.
GDP versus GNP.
So our last but one slide was the computation of the GDP.
The computation
of GDP. Then the next one where we stopped was the GDP. Yes. No. Said the next one.
Yes.
Yeah.
Yes.
Yes.
Okay.
Yes.
People are relieved. Okay, that's good. So we will start from here. Let me just step back the computation of GDP, and then we can continue from there. Okay. So we said that this equation is very important, the expenditure approach, where is the GDP. Why is the GDP? I hope you guys can hear. Please, is it just me because I can't hear? All right. Okay. So government expenditure on goods and services, we said the Y cost consumption, investment, government spending, net exports. And then I explained the implications. If you have total, and the net export is export minus imports. Okay. So that is very important. And I said that on a policy level, it's important that as a country, we export more than we import. Let me mute everybody. Okay, so it's important that we export more than we import. In that sense, then the NX becomes positive. Okay, but if import outweighs exports, then the NX here will be negative. So it's important that this understanding is very clear when it comes to the variable export. So that is what we have. And then GDP versus GNP. Okay. So we said gross national product. So far, if you talk about the gross domestic product, let me just step back also and recap the definition. Oops. Okay. So the definition that we said we define GDP as the market value of final goods and services newly produced within a fixed period of time within a geographic boundaries of a country. So if you are looking at the GDP here, we are looking at what is the value of outputs that we produce as a country. How much is it worth? What is the value? Okay. What is produced within Ghana, within the geographic boundaries of a country? When we go to GNP, distinction there is that for the GNP, we are looking at the output produced by the nationals of that country. And that's why we call it the gross national product, okay? So the gross national product here is the market value of final goods and services newly produced by domestic factors of production during the current year. So the key is the domestic factors of production, domestic labor, capital owned by Ghanaians. So that is the key difference here. Whilst one is gross domestic product, this is gross national product, the output produced by the nationals. Okay, it's possible that you live in a country, but the output is produced by foreigners. But when we count the GDP, it's so high, but most of the GDP is as a result of it's coming from foreigners. I think we ended on this slide. Okay, so I'm going to start from there. I think I explained that distinction. So the distinction here is that this is the total final output produced by nationals or citizens of the country. And there was somebody who was asking the question about the net factor payment just before we ended that class. So the difference between the GDP, the gross domestic product, the output produced within the country, and the output produced by the nationals of the country is called a net factor payment from abroad. So it's the net that we have. Okay, so it's possible that if you have the national product is not so much, meaning that what was produced by Ghanaians or Ghanaian factors of production is not so much, then you see the foreigners are adding more to your GDP than you are adding to other countries, or Ghanaians adding to other countries. So the difference between the GDP and the GNP is called a net factor payment from abroad. Okay, the net factor payment getting from abroad. Okay, you hope that it's positive. That means that the GDP that is coming, that you are getting, the output that you are getting is coming from Ghanaians. Okay, so that the net factor payment from abroad is not so much in that regard. All right. From GDP to disposable income, it's easy to see the link between GDP and disposable income. So if you have the total income, what is the disposable component? Okay. So from GDP to disposable income, private disposable income is the amount of income available to the private sector to spend. Okay. So the disposable income that we have, if I take myself at the individual level, at the household level, my household disposable income is the amount of money that I'm left. And if we add that up for all households in Ghana, that gives us the private disposable income. Okay. And this is the disposable income from which I can invest. Okay. So if I don't have a lot of disposable income, I will not be able to set up a small business and all that. So it's important that, as we found, that it's important that people have enough to spend and also enough to save in an economy. Okay. So this is income after deductions. So that would be my disposable income, or the private disposable income, the sum of it all at the country level. It is the income after deductions. Okay. So if you take the taxes, okay, if I get my gross salary, taxes are taken, pension contributions are taken, then whatever left will be my disposable income. And at the country level, to the level of disposable income we have at the country level, after netting out all these tax deductions and SNIT payments. Plus, then if you get any transfer payments, if you live in an economy that gives you free money every month or child support or family support, then it becomes part of your disposable income. Okay. So from GDP to disposable income, all the income that we have output, the production of final goods and services, it's not all that we are going to spend and not all that we are going to save. Some will go into taxes. So tax revenues are important. The net factor payments, the paid to, as we said, income paid to domestic factors of production by the rest of the world, less income paid to foreign owned factors of production by. So that is the gap here. All right, so now just work with me, try and work through this. So from the economy point of view, or for the economy as a whole, total private disposable income will be given by what? Okay. So total private disposable income will be given by the Y that we have, which is the GDP or the GNP that we have, the income that we have. So if it's at the individual level, it's your income. If it's at the country level, it's our GDP, plus the net factor payment from abroad, plus your transfer payments. So if government is or private sector or the households, any transfers, then that will be an addition, transfer payments from government. And if you get any interest payments on any investment, it becomes part of your income. All right. So the left-hand side here is the total income. So the income that you receive from the job you do, from all the jobs that people in the economy are involved in, the net factor payment at the country level, the transfer payment, the total transfer payment in the economy, the interest payments that firms receive, minus the level of taxes in the economy will give you the private disposable income. Okay. So the level of private disposable income in the economy is given by the income people receive, the NFP that is received, the transfer payment people get, the investment interest that they receive. That will be the gross income minus taxes. Already, you can now begin to think broadly. If you live in an economy where your disposable income is high, right? But if you live in an economy where your Y is small, your NFP is small or even negative, your transfer payment, government gives you nothing, zero, and you have the level of interest payment people receive in the economy is close to zero, then the disposable income that people will have will be very small. And on top of that, you may be in that country, but on top of that, you also pay a lot in taxable income is going to be very small. Okay. So to this point, just keep in mind that disposable income equals your Y plus NFP plus your transfers, the transfers that you receive. Just make sure I'm saving this. Yeah. Your interest, your taxes. Okay. This is straightforward. Even at the individual level, your disposable income will be your income minus your taxes. But here, there are other sources of additional income. Okay. So keep that in mind with NFP plus TR plus interest payment minus taxes. Okay. National income accounting identities. Total savings in the economy is therefore the sum of private and government savings. Okay. Okay. So the level of savings that we have in the economy will be savings coming from the private individuals or firms within the economy. So the total savings we have is how much are you saving every month, or how much are you saving every year? How much am I saving every year? How much is the next person saving? That, and that will sum up. That will be the private savings. And then government savings. How much is government saving? Okay. In economies where the infrastructure gaps are very high, you find that the government is not saving. Okay, government is borrowing so much. Okay, so then the total savings in the economy is very small. But you need quite a lot of savings so that this savings will translate into investments, right? So that is the very important thing that you keep in mind. You want an economy, or you want to be in an economy where private savings is high and government savings is high. So it's easy for people to get access to funds and invest. Okay. If you take certain countries, they have very high savings culture. Somebody gets 100 Ghana cedis and is saving 80 Ghana. But if you go into certain economies like ours, where consumption is very high, somebody gets 100 Ghana cedis, he's spending 150 Ghana. Okay, so then we are always in debt. So at the household level, we are in debt individually, and at the country level, we are also in debt. Okay, so just keep these things in mind. It's important that we will look at the implications of low savings and high savings in the economy. The total savings up to this point, we are saying that is the sum of the private and government savings. So we can rewrite this. Okay. And private savings is disposable income less consumption. Okay. So that will be your savings. So your savings at the private level, or we as private people, not public government, our savings will be our disposable income, how much we have in terms of disposable income after taxes, minus our consumption, okay, our level of consumption. Okay. But from the equation before, disposable income equals Y plus NFP plus TR plus interest payments minus taxes minus, now we are doing minus consumption. So the old equation for disposable income ends at minus taxes. Okay. But for private savings, how much you save is after you've consumed, so minus C. Okay. I hope that is clear. You're giving me more tea. Okay. All right, so if you didn't get it, please, you can step back. I'm happy to go back for you to see that. The disposable income is all this minus taxes, your income minus tax, the taxes in the economy. And if you are doing savings, your savings will be your disposable income minus net consumption, okay, minus consumption. Okay, so that is minus consumption. Okay. All right, what is government savings therefore? What would be, how would the government's, what would translate therefore into government savings? Government savings is government net income. Okay, that's government net income. Net less government purchases, okay, government spending. So government will say, how much money is government receiving, or how much money are we earning, and then how much are we spending? Okay. If we spend less than how much we are receiving, then government will save, right? Okay, so that is the equation. The net income less government purchases, that will give you government savings. So T here will be the tax revenues government is earning, or government has, minus if government is giving the private sector some transfer payments, like the child support, family support, then you net it out. If government is paying any interest on some investments, then you take it out, and then you take out the government purchases, okay? Expenditure on roads, expenditure on hospital. Okay, if you take that out, then you'll be left with the government savings. And as I was saying, in many developing countries, government is always negative. I would say government is always negative. Yeah, in many developing countries, our G, even forget the middle, the transfers, even when the government has zero transfers, right? Zero interest payments. The expenditure levels are so high. It's higher than how much money we are collecting in tax revenues. Okay, so that makes it a problem, and somebody is saying that we are always in negative. Okay, so national aggregate savings is therefore the sum of the private savings and that of the government savings. Okay, so the level of savings in our economy therefore will be how much is the private sector or the individuals in the economy saving, plus how much is government saving. Okay. And that will give us the level of savings in the economy. And as I said, there are some countries, the private sector savings, the private sector savings is very low, and government savings is close to minus. Okay, so the level of savings in the economy, in the banking sector, in the financial sector is very small. Okay, so getting access to loans are difficult, and therefore, even if you get access, interest rates are very high. Okay, the liquidity levels are very low in the sector. Okay. So that is what we have here. Total savings S equals private savings plus government savings. Okay. If you combine these two terms, okay, if you combine these two, private with P plus TR plus INT minus TC minus C plus all this, the government first, TR, all that. That will give you the savings. Okay, that will simplify the equation and give you total savings in the economy being given by Y plus NFP minus C minus G. Okay, it's not very difficult to see this because you have minus T here in the private savings side, and then you have plus minus T, which is taxes. So minus T, but the government side is plus T. So minus cancels the plus, so T cancels itself, okay? And then what else cancels itself? TR is positive here, but it's coming from government, okay? So it cancels itself. Private sector is receiving transfer from government is giving, so that cancels itself. Interest payments, INT is plus in the private savings equation, but it's minus in the government savings equation. So basically all that cancels out. So you're going to be left with Y NFP from this equation minus C from the equation, and then the last equation from the government side, you just have minus G. And that also gives you an idea about the level of savings in total in the economy, which is given by the income NFP minus all the aggregate consumption in the economy minus the government expenditure. Okay, so that will translate into the total savings. So we see that if you have an economy where even if government is having negative savings, but private sector saves a lot, that can go into the what do you call it, the government expenditure. So basically private sector is saving a lot that if government needs like money, like treasury bills, OP floats, treasury bills, people have individual savings that they can go and buy. Okay, but if private savings are very low, people cannot even buy the government T-bills, then we are all in trouble, okay, in the economy. So you hope at least private sector can save government, the private savings can address government saving shortfalls. Okay, you hope that. If that doesn't happen, then private combined with government, private sector has negative savings. We all are consuming more than we are earning, and government is consuming more than it's earning. Then the aggregate savings in the economy is minus. Good. Countries like Japan, where savings are very high, private sector savings is really high. People are saving so much, buying shares, people are investing in so many things. Okay, so this is the implication. Don't just memorize the equation, but just think through the implications. Okay, if you take government savings, look at the implications. If you take private savings, look at the implication. And then if you take the total savings, look at the implications. All right, uses of private savings. What do we use private savings for? Starting with the equation for national savings, we can substitute the expression for Y. So I'm rework this whole equation. We know total savings is Y plus NFP minus consumption minus government. But we know already from our equation that Y, which is equals consumption plus investment. Okay, so our Y, right now we are substituting for Y, right? So Y equals C plus I plus G plus NX. Okay, can go back for you guys to see that. So this is Y. Okay. So Y is C plus I plus G plus NX. So wherever we see Y in the savings, the total savings equation, we can replace that by C plus I plus G plus NX. So we are aiming at, I'm going to show you the key part is how to understand government budget deficits. Okay, how do you relate that to the current account deficits that we have? Okay, so this is where we are now. Savings equals to Y plus NFP, net factor payments from abroad, minus consumption, minus government expenditure. Okay. So, and then you can expand this wherever you see Y is C plus I plus G plus NX. Okay. So that the first four terms here is just Y. Okay. It's just Y. And the P minus C minus G. So that is the full equation. Okay. Can always reorganize this term, and then that can, if you reorganize this term, that can give you savings equals to investments plus NX plus NFP. Okay, so some of these things will cancel out, minus C minus C minus G minus G. So these will cancel out, and then you are left with savings equals to I. Keep in mind, this is plus C, this is minus C, that will cancel out, plus G minus G, that will also cancel out. Okay, so your total savings in the economy can be re-expressed in terms of investment. Okay, and that is savings equals to I plus NX plus NFP. Okay, so you can already tell from this equation that the level of savings is will influence the investments that we have in the economy. If people are not saving, then we cannot invest, right? So much, you cannot invest so much. Okay. So if I have a lot of disposable income, if I'm earning, I don't know, 10,000, 20,000, whatever amount you are earning, if you are saving a lot, then you can start a small business, you can invest. Okay. So we can express savings in this in terms of investment and then net export and all that. Okay. So savings therefore to the investments plus net exports. Okay. So once again, you hope that your net export is positive. Okay. So you're exporting more than you're importing. And then plus NFP, okay, net factor payment from abroad. So that will give you the total savings in the economy. So if we express it in terms of that, to further simplify it, we are saying that the sum of the net export and net factor payment from abroad, NX and NFP, is called the current account balance. Okay, so the current account balance for the country is basically is the net exports and the net factor payment from abroad. Okay, so that gives us the current account balance. So that's why some you look at some countries' current account sheets, and it's negative. negative. Okay, so they have deficits in the current account side. It means that if you look at exports, negative, and net factor payment from abroad, also negative. So the sum of it, negative. So here we have the sum of the net export and net NFP referred to as the current account balance from the balance of payments account. So that is what we can express the savings equation as savings equals investment plus current accounts. Okay, savings equals investment plus current account. We can further reorganize this. What is the difference between savings and investments? Okay. Savings minus I will give you the current account balances. This equation is not just a simple equation that you see. As I said, always think about the policy implications. The level of savings in the economy goes into financing investments. Okay, the level of savings in the economy goes into financing current account balances, okay, or deficits, or all that. Okay, so if you have a very low level of savings, then it has implications on these two important variables. Therefore, this equation states that national savings are used to finance national investment and the current account balance. Okay, so you need that. You need to finance the level of the level of investments. Okay, comes from our savings at the country level, and the level of savings comes from both private savings and government savings. Okay. In countries like the Scandinavian countries and all those, like Norwegians and all those Swedish people, in most cases they have very high savings. Okay, and therefore they're able to, so the high savings level helps them to invest and in the economy, and it helps them to finance only all export activities. Okay, so the current account, they can even have an excess. Okay, it also means that the current account balance is the excess of national savings over investments. Okay, so as the excess of national savings over investment gives you the current account. It's just simply saying current account balance here is savings minus investments. Okay, savings minus investment. Under what conditions would the current account balance be negative? So from this equation, that should help, can tell you this. Okay, so you can already tell that if your desired investment is so high but you don't have enough savings in your country, then it's going to be minus. So it means that the current account balance here is the excess of national savings over investments. Okay, if the country is saving more than they are investing, then you have the excess, okay, surplus here, which would be the current account surplus here. So we have a lot of savings than is being invested. But if we are investing more, but the domestic savings that we have is too little, then you are going to have this what do you call it? The current account deficit, which now you have to go and find some money to finance it, because your desired investment is high. You want to invest, government is building roads and all that. I could say, reply a call for me. Okay, so in effect, you can have deficits on two sides, and that is what we are going into, the twin deficits. You can have this deficit on the government side, and you can also have deficits on the current account side. Okay, so the twin deficits here, we are saying that the national income accounting identity can be also used to illustrate the so-called twin deficit problem. This is the relationship between government budget deficits and the current account deficits. Okay, so you have deficits on two ends, government account, the budget deficits, and then you also have current account deficits, where if you go back to this step, then you have excess investment over the level of savings in the economy. So savings is very important, okay, not just at the household level or individual level, but at the country level. You want a country where people are actually saving or investing. Okay, so here the savings will translate into some investments. All right, so this is the relationship between government budget deficits and current account deficit. And from our previous definition, GNP that we talked about, the GNP is given by this. So if you take the GNP is given by C plus I plus G plus NX. And because it's GNP, we add in factor payments. Okay, we add in the next factor payment. Using that identity that we had, you can rewrite this equation to be this. So NX plus NFP gives us the equation that we got, the current account balances. Okay, so these three terms here most is the same as G plus CA, and then you have consumption move to the left-hand side, investment move to the left-hand side. Okay, just to demonstrate this twin deficit issue that we are talking about. And you can already tell here is income that we have, consumption minus our investment. Okay. If you subtract taxes from both ends and you simplify it, that will also give you clearly the relationship between the deficits. So if you take out minus taxes, so Y minus C minus I minus T, which is minus tax, and then you subtract the tax also on this end. So minus T will be on this end. If you simplify it, whilst we know what is savings minus investments, you already know savings. So if you go back, savings I plus C, savings is also given by I minus NX and all that. You can simplify the equation to be savings minus I equals to the current account deficit minus T minus G. Okay. This is the understanding behind this. The difference between savings and investment equals the current account balance minus tax minus G. Okay, so this equation states that the excess of private savings over investment finances the government account and the government budget deficits. Okay, so still linked to the importance of savings, that the excess, if you have a lot of savings beyond the level of your investments, then the extra savings, you can hand it over to government to some extent, right? So then you can, I have a business, I'm running a business, I have income from other sources and I'm running a business, I'm investing. If after my investment, I still have a lot of money left, then I can buy government T-bills and other things, right? So I can go in and bail out government if the need be. Okay, so this equation states that the excess of private savings over private investments, if I have savings beyond my own investments, then that savings can go to finance any current account deficits, okay? And can also go to finance any budget deficits. T minus G is your government budget deficit. Okay, so government budget deficit is T minus G, and you can finance that from savings, excess savings. And the current account deficit can also be financed from savings, excess savings, okay? Or savings, when you have savings more than your private investments. Okay, so if private savings equals investment, then what is the problem? Okay, so if all I have finances, or the private sector has finances private investment, then current account will equal government budget deficits. Okay, so then we have an issue there. Okay, so we have the tax revenues here will be less than the expenditure, the government expenditure. The government expenditure will be very high. So you are in good position if you have excess savings over investment, or the private sector has excess savings over investment, then that can go to finance this twin deficits. Okay, the deficit in current accounts and then the deficit in the budget. Okay. The last expression suggests that if the government runs a budget deficit, okay, in the absence of excess savings from the private sector, this translates straight into current account deficits. Okay. So if you can't balance your books, okay, you have it, how are you going to finance exports, your exports? Okay, so that is the big problem. So the land runs a huge or any budget deficits in the absence of excess savings from the private sector. In the presence from the private sector, then the private savings can go and address these things. Okay, but in the absence of excess savings from the private sector, then the budget deficit, that is just budget, or the idea that, okay, you have a gap. Okay, so then the budget deficit translates into current account deficits. So in a nutshell, it is not a very good idea. Okay, it's for developing countries, it's tricky to say, okay, we will not have budget deficits, okay, because our goals as a country or as a developing country is huge. We have to fix the road, we have to fix the schools, but like the gaps, the infrastructure gaps are huge. So it will always be huge. Or like, I hope not forever, but yeah, government expenditures and the public sector is big already, so paying high salaries, but they have to finance all that by your tax revenues, but the tax revenues are low. Okay, you see the dilemma that the government finds itself right now. Fix all the potholes on our road, at the same time you are not getting so much in tax revenue. So if you are not careful, you'll be forced to increase taxes. But if you increase taxes so much, then it affects people's disposable incomes, right? And if it affects their income, then how are they going to save, you know, to come and bail you out when you have these deficits? It's a whole vicious cycle that you don't want to get in. Okay, you don't want to get into that. Okay, because then you want to be able to still produce a lot of output, so that even if you impose a small tax rate, your tax revenues are more. Okay, but if you are just imposing higher taxes, then it will go back to affect people's disposable income, and therefore they may not have enough savings beyond their own private investments to help you finance anything. Then if after all my consumption and investments, I have only 100 Ghana cedis, I'm not going to open an account, put in a bank, for the bank to accumulate all the savings and give it out as loans and even finance government deficits. Okay, so it's a very simple equation, but a very powerful equation. The fact that excess savings, excess of private savings over private investments can help to finance the government current account and also the government budget deficits. So that is an idea, the identity that you should keep in mind. So there are two identities there: income approach, the expenditure approach, if you are calculating the GDP, and then the identity regarding the government current account and also the deficit, and the fact that excess savings can help to finance these two things. Okay. Uses and misuses of GDP. Even though we say that, okay, make sure that you are able to like get information on all the output that are produced in the country. In a lot of developing countries, as I said last week, a lot of the output that we final products and services that we produce are not counted. Okay, so in some countries, as I said last week, babysitting is counted. People get paid a lot. In fact, there are people who have the full-time job is babysitting. Here also, but it's not. If your grandmother babysits for you, you're not paying, but it's an economic activity. Okay, they will have a whole meeting in your family if you have to pay. Okay, certain economic activities are not counted. Prostitution in some countries are counted. Netherlands and a lot of European countries, they count that. In Ghana, it's illegal, so you cannot count these things. So it's very important. You can't count them. A lot of the informal activities are also not counted. Okay. So the idea here is that when you are using the GDP indicator, also you have to understand the lapses also in the economy and how to use them. So you see that, especially in election year, you find that people will be misusing the indicators, like GDP indicators. Somebody say, oh, during my era, the GDP was this, and another person will say, during my era, GDP was this. Okay, when you are assessing economic performance over time, if you don't have the very good background, you may be using the wrong indicators. Okay. All right. So typically, to say that the GDP of Ghana is said during my era or 5 years ago was 10 million, and now it's 20 million. So 20 million is higher than 10 million, and therefore it's okay. It's doing a very bad analysis. Okay. So the barest minimum will be to calculate the GDP per capita. Okay. And what do we mean by the GDP per capita? Dividing the GDP population. Okay. 10 million, the output 10 million was produced by how many people in the economy? What was the population of Ghana 5 years ago? What is the population now? Okay. So you have to rescale that GDP. Okay. So GDP per capita is saying the value of the final goods and services that we produce in a country divided by the population that we have. Ghana, we are going to have a census this year. Estimates are around 35 million. And so if you are doing a 10-year decadal analysis, then the population 10 years ago, I'm not sure it's the same population today. Okay. So I know that the politicians among us sit on radio and like, okay, like we waste the whole year making arguments about these indicators. Okay. And sometimes they are using different numbers, throwing out different numbers. The barest minimum is to scale this by the population. It's also good for us to compare the performance across different countries. The GDP for Nigeria, for example, will be very huge. Okay. So the GDP for Nigeria will be big, but the population is also very large, Nigeria. Okay. So the population is very, very large in Nigeria. I don't know the current population. I think they are almost close to 200 million, between 180 and 200 million people. Ghana is around 30 million. So it's like Lagos State. Okay. Okay, so the population is big. So, but Nigeria has a higher GDP or has a higher, the value of their final goods and services is high. Yes, they have a large population. Okay. So that is it. But I also have to play the devil's advocate. Countries like, okay, Bismarck, yes, I can take your question and then go on.
Say good afternoon.
Afternoon.
Say please, it seems sometimes some of the economists make some comparison between Ghana and Nigeria. Is it feasible?
That's what I'm talking about.
Population.
That's what I'm talking about. That is not, it doesn't make sense. Like you can compare, yeah, but compare in a realistic way. Okay, unless you have let me talk about the population scale up, and then if you think that still it's not comparable to do that, then we can still go into that. Let's say maybe some of you have calculators already. Let's say Nigeria has a huge GDP, right? But if you divide it by the population, maybe their per capita GDP will probably be around 1,000 USD. Okay, about 1,000 USD. I don't know. We have to check. Those who have internet on their phones can double check the per capita GDP for Nigeria. And then Ghana doesn't have a huge population, but if we still also divide our GDP by our population, you may be surprised to see that our per capita GDP can be even higher than that of Nigeria. Okay, so middle income country. Okay, because we are producing more output compared to the population that is doing that. If Nigeria has 200 million people, then what is the level of GDP, okay, that these 200 million people are able to produce? Okay, and then what is the level of GDP that 35 million people in Ghana are able to produce? So that is how you can, at least at the barest minimum, compare. But you cannot say that, oh, Nigeria has 3 billion or 50 billion in GDP, Ghana has this. No, at least what is the GDP per capita? Class rep, you and your people, you can easily Google that for us. the GDP per capita for Ghana, and then the GDP per capita for Nigeria. If somebody finds that, yes,
that of Nigeria is $2,300.
2,300 USD. As at
That was 2021.
2021.
That's the projected trend.
Okay. And then that for Ghana is what? The projected trend is what?
Ghana is 2,202.12 USD as of 2019.
As of 2019, so 2002
and then the projected for 2021 is 2,199.88.
2,299.88.
Yes.
Which is close to that of the Nigeria.
Yes.
Nigeria is 2,300, they're projected, right?
Yes.
And Ghana is 2,209. So that is what I mean, that then you can compare the two countries on GDP per capita, but not on absolute GDP, because on absolute GDP, the population is very huge. So then you can do the comparison on that basis. It means that if we share the GDP, the income that we have as a country, or for the values that we got from our output by the number of people in Ghana, each person will get 2,299.85. We share that. Okay. Let me see the comments. And then, so Nigeria GDP per capita, yeah, somebody has written that. Yeah. So that is at least the barest minimum that you should do. If you are comparing the GDP of Togo to that of Ghana, obviously Ghana will be higher because you have a bigger population. So if you rescale it by population, you can do a better comparison. Okay. Having said that, there are some countries with a very small population, but a very high GDP. Okay. The Norwegians, the Scandinavian, Norway, for example, they have, the last time I checked, their population was about 6 million. Okay. And they have so much in GDP because they were able to manage their oil resources so well. Okay. So they have a lot of resources, and they have so much GDP that they look around the world and see. And if you compare it to the government expenditure, they are not spending a lot on infrastructure. They have already built all the roads and all the schools. So they are not spending so much. So they have budget surpluses. Okay. So the tax revenue, or the revenue they have, is way higher than their projected expenditures. So they have surplus. So when you have a surplus, you can go and support other countries. So they look around the world and say, hey, who can we help this year from our tax revenues? Okay, then they will come and give us, budgetary support. So you see how insane this is. They are giving us budgetary support from their surplus, right? And then if it comes into the country and one guy hijacks it and go and build himself a hotel, it doesn't make sense. Okay, because it's coming from their tax revenue, taxes that people in their economies have contributed. And from that, because of the surplus they have, they come and then they give it to us. And then if we end up misusing people's hard work funds for our own personal gains, like huge corruption and all that, then it just doesn't add up. Okay, so these are some of the issues. Norway, somebody can also Google that. I don't know the current population, okay? The current GDP population of Norway, or the GDP per capita. If you find it, the GDP per capita also, you can let us know. But I'm really positive that it will be in the high 5,000s or 6,000s. Yeah.
Doc, did you say Norway?
Yes, please.
It's expected to reach 90,500 in 2021.
And as at 2019, it was 75,419.
And then as at 2020, it was 89,000.
I don't know why I came back. So you see the issues, like per capita. Okay, that's how high. And on top of that, if you've been to Norway before, you see that the TR is very high. The transfers to private sector, those who live government transfer support to children, the number of children is, people are giving birth more kids because each child gets a lot of TR, government transfers. Okay, so one country is around 90,000, and another country is around 2,000, and the oil reserves that Nigeria has It's very comparable to that of Norway. Okay, so these are the issues that we have. Okay, so if you compare ourselves to Nigeria, we are not doing badly. But if you are comparing ourselves, maybe Norway is an outlier. Maybe we just find another country, maybe Kenya or some other countries, then we can compare. Okay. All right. So I'm saying that at the minimum level, you can use the GDP per capita, but not the absolute GDP. The absolute GDP for Norway will be very high, but they also have a very small population. Okay, so when you divide it by that, then each person is about 90,000. That's quite USD. Okay, that's quite a lot. So their value in that small country is very high. Okay. All right. So that is the bare minimum. How well is the Ghanaian economy doing today compared with 3 years ago? At least you should do that analysis, scaling it with population. So GDP per capita, not the absolute GDP. Okay. Ghana is a middle income country, so we have about more than 2,000 per capita income. Okay. But does that mean that if the GDP or even the GDP per capita, if it's increasing, does that mean that economic well-being of the people within the country is also increasing? Can we say that? Can we say that as our GDP increases, or even better still, our GDP per capita, as it improves from 2,299 to 3,000, can we say that the well-being of the people in the country have improved? Anybody? Can we say? You can just raise your hand up. Or you can... Yes, Francis. Go ahead, Francis.
Say no.
Why?
Say many times
Why can't we say that?
Say.
Go ahead, please.
I said many times the money, other people might be suffering, that the money go into some individual pocket.
Exactly. So can you, and better, sorry, can you go ahead?
Oh, I was.
Or James.
I was saying no. It
Yes.
doesn't.
Go ahead.
So
why? I need a why.
Oh, because if we are to, you see, with the consensus, sometimes in when population consensus is being done, I don't think it's everyone that is counted. Some people might be left out of
another problem.
The counting, so it doesn't reflect the reality of what's going on. That's what I think.
So that is another problem. Developing countries. The last census, Annabetta, were you counted?
No, I wasn't. You see, no one came to my house.
Yeah, I wasn't counted also. So if we have a problem with that indicator, so developed countries, they really know at any point in time the number of people in the country, because they don't rely on censuses. That's one of the things that Saskaspace has been talking about. They rely on administrative data, because when you are born in the country, you are already counted, right? And when you leave, the data is also captured. And wherever you live in the country, you have to register that you live in, say, I am a resident of Accra. You need to be counted. So you don't have to count people like a census. They already know at every point in time. And that is the use of administrative data, and not like actually setting a week or a month to count people. Okay, we are doing it in the Bible way. Okay, so she wasn't at home. Yeah, Tiflo said you were not at home.
Please don't mind this line.
Yeah, there was another hand. Let me. Yeah, James, and then I'll come to Abdul.
Okay. I think most often you can get a situation where some few people are producing very, very high in an economy, and then majority of the rest are just doing a little. So the huge per capita income might belong to some few people. Most of in Ghana, it is foreigners who produce most of our things, especially in the gold sector. Yeah, they end up outside the economy.
Yeah, we have to change that. So it's not enough. Like if you go and talk to, I like teaching this class because we can have these discussions. If you go and talk to some of these people, foreigners who have these businesses, we are more educated than a lot of them. Like average Ghanaian is now like the average is approaching a master's now, or like no, I mean the educated people. A lot of people are having degrees and all that, but then when it comes to the business activities, we are not very prominent. It's a lot of some of them don't even have any formal education, but they are doing so well in our economy. Okay, so we all have to begin to think of how well to, because that's where the money is basically. The public sector, unless your GDP can be very high, but it's coming from a few people. Okay, a few people control the income levels. They have all the production base. The production is coming from them, and therefore the fact that output is increasing doesn't mean that everybody in the economy is doing well. It may be that output is increasing for just the top 1%. Okay, or even just the politicians that have everything. The output is driven by them, and everybody else is living on handouts. Like we have to go and beg to get income. Let me take Abdul, and then I can summarize all the other dimensions. Yeah.
Doc, is it not applicable to the working population? So should the GDP increase, it will necessarily reflect on the living conditions of the people, because I think the benefit wouldn't apply to everyone.
Yes, it wouldn't come to everyone, but you also expect that if the company is doing well, then working conditions will improve even for the worker, right? But it could be that the company is doing well and the CEO is just buying himself a jet. Right? You see, the CEO is buying himself a jet and building story building like skyscrapers for himself, but it's not translating to the cleaner who works in the very company that gives him the money. So just in support of what you're saying, somebody makes a very important point, and that is also key, that capital required. Okay, capital required. The foreigners coming in, they come in a lot of capital. They come in a lot of capital because access to funds in the economy is easy. Okay, they can get access to funds because savings rates in their economies are high. So when they go to the banking sector in their economy, they are getting interest rates of close to 1%. Okay, and then here you are getting close to 25, 26%. So you can't compete. Okay, so it's a cycle. Once you don't solve the structures or you don't solve those, put it in place strong structures, it's very difficult, very, very difficult to jumpstart the economy or empower the people within the economy to really start up. If you need loan right now to start a business, the interest rate alone will scare you. But then they are getting cheaper source of credit to come in here, and they're producing everything. Go to the spin tests and all those places, and it's all of them. But we have to be active also in that value chain. Okay. That's where the wealth creation actually comes from businesses. Working for someone, your income level is capped. Okay, so yes, GDP, is it a good indicator of economic well-being? Some use GDP as a measure of economic well-being, meaning that higher GDP per capita means higher income, ability to meet basic needs and more, but there are distributional issues when you use GDP or GDP per capita. So there are no more limitations to using GDP as a measure of economic well-being. The first one, some of you indicated that distributional issues. The fact that income is increasing does not mean that increasing income is well distributed among the people within the country. And that is exactly linked to inequality, the gap between the rich and poor. In very not well-structured economies, even as income levels increases or the GDP per capita increases, the gap between the poor even widens more. Okay, it's not that the rich are gaining, but even they are gaining more than the poor. The little that the poor are getting is in comparison. You know, if the gap between the rich and poor exists, but the gap is say 50 Ghana cedis, if that is the gap, it's 50 Ghana cedis between the rich and poor, maybe it's not a big deal, right? The poor earns 50 Ghana, the rich earns 100 Ghana. But as the output increases, the poor is now moving to 10,000, the rich is moving to 10,000, and the poor has stagnant income, still at 50, with even a lower purchasing power because prices are increasing, because some people have a lot of money. Okay, so it's not difficult. Walk through Accra, you see that the home prices are approaching $1 million, and it's just wide, and people are still buying. So the top 10% can afford, and therefore is driving up the price, and the bottom 10% cannot even afford a rent of 50 Ghana a month. Okay, so the gap, the distributional issues, the rich is getting richer and the poor is getting poorer. Okay. So if you look at GDP on the surface, it does not matter if only the president owns everything, all the resources, and the rest of the economy, or the rest of the people in the economy just have. Then it doesn't matter, because you are just dividing the output by the number of people. Okay, so it doesn't address distributional issues. Okay, and there was a joke some years ago that the former president of a country had more money than the country. Okay, you could actually give the people a loan. Okay, the world centered in the hands of a few. Yeah. Okay. So it doesn't mean that as GDP per capita increases, the well-being of the people necessarily improves. So we have to look at distributional issues. There are other non-welfare elements that are added to GDP. So government expenditure also increases. Government also spends on, say, military stuff. So high military spending does not mean that our standard of living is improving. So it doesn't mean that the fact that government is spending, it means our well-being has improved. Depends on what government is spending the money on. Okay, so these are some of the things. Okay. Somebody's saying something about through a bank. I didn't get the whole story. If you want to explain, you can explain that for us. Okay. So non-welfare elements add to GDP. Non-market production, as I said, not every good or service is counted in Ghana, so you cannot use that as an indicator. It could even be the reverse, that there are a lot of people that we think are poor, but they are doing so well in the informal sector, but we cannot just count their activities, and then we don't even know their real income. So if you are using an income approach, the guy is not telling you their real income. Okay. If you do the census, if they have an income question in the census, you see the number of people who avoid that question. They will say that, or they will report their former salaries, but not the money they are making from the informal sector. Okay. So there are a lot of activities that are not counted. Babysitting is not counted, but employing a nanny is counted. Okay, so a lot of activities are not counted. And then the very important point raised by Betha about a lot of people also not being counted. Okay. Any question? Any question? The person who raised the issue on the chat, you can also raise it. Theophilus, go ahead.
Sir, would there be an instance where people might be double counted?
In the census?
Yes.
I don't know. What's your experience? Like people get counted in Accra and then they'll make themselves available to be counted again.
Because unlike Anne, who was in home, I was home when they came to count. They would ask whether you have, they will ask your parents whether they have some relations, or they will ask you whether you have relations, where they are, and all those things. Yeah.
I get a point.
So would that result in them overcounting?
It is possible. It is possible, but you don't expect that the overcounting is so huge. If what you are explaining is true, that okay, you are asked and you mention the peoples, then they count them, and the person is counted again in the office or somewhere else. Is that what?
Yes.
What you mean?
Yeah. So like they come home and it's not home, they will ask the parent or anyone who knows, and they say, oh, we have a daughter called Anne. Then they get to where Anne finally is, and they count Anne. Wouldn't it be double entry, and wouldn't that overpopulate?
Yeah, I don't know in real sense what they did, the last census, what they did 10 years ago.
Hello.
Yes, go ahead, please.
I happen to be part of the 2000 census.
Okay.
What they do is you count people where they slept. You take the information from the person you meet in the house for other people who reside there but didn't sleep there, but you won't count that one. So you are counted where you slept.
On the census night. On the census day.
Night. Yeah. So it's like taking a picture of the whole country at that time. So wherever you found yourself, even if you were in the street, you'll be where they found you at the census night is where you'll be counted.
So that double counting will not happen. Is that what you are saying?
That one would be a technical mistake from the enumerator or the supervisor. But it doesn't come easily. Then again, I was raising another issue on borrowing from abroad. You know, why is it too difficult? No, the developed country, they are always fighting for liberalization of trade and those things. And Capita too is part of it. Why is it not liberalized to the extent that competitive rates can cut across the global market, and then we all get access to the foreign loan? Because there are some countries with negative interest rates and so on. It means they have idle excess funds.
Yes.
And so they should be able to release those funds to areas where we are all deficit spenders, so that the liberalization can be complete. But they are only talking about trade liberalization, leaving out the capital, and that is our being. And I don't see full good faith in the whole global economic paradigm now.
Yeah, it's like each man for himself, my brother. Each man for himself. So they will get access to the loan. Come back here. I heard yesterday the president was convincing people from Spain to come and invest. So they have cheaper source of capital. They come here and then they set up the businesses, and then they can employ. At the end, the employment effects, if it's better that they at least come into the country and produce it and employ people, rather than producing there and we stop buying the products from there. And then that is the worst case for us. Okay, so for the international market, for this whole liberalized sector, for you sitting in Ghana to go and get credit in the US market or the Canadian market to come and invest here, I don't know if it's ever going to happen. Maybe we can rely on our diasporans who live there to be bringing back cheaper credits to set up. And then because the interest rates are high here compared to them, we can rely on them. But if you are not a resident there, it's even difficult. Yes, better. Johan has been up for a while. Sorry.
Yes, so I was going to ask you the non-market production. So can we take it, for example, so what is stated here is babysitting is not counted. Meaning, if my sister gives birth and then I go and babysit, it's not counted. But if the babysitter is from my agency,
then it's counted.
Okay.
So if you have an economy where a lot of these things are not counted, then you are underestimating the actual GDP. Okay.
But is it there in a country like US?
Yeah.
There are people that babysit. Like maybe you get an 18-year-old and above person, and then it's a business they are doing, and they are paid. So is that also that's considered under GDP?
Unless the person is doing on a table, where it's just, oh, my friend, just give me $10 when you're bringing a child. Yeah, but it's illegal. Every economic activity, you have to pay taxes on them or declare so that they know that every year in Canada and US that I know, every year you have to file your taxes.
Yes.
So when you file, you have to declare. I remember there was one time they said you have to declare your global income. I'm like, are you kidding? If I have an apartment in Accra, I'm renting, I'll report in the US that I have this income in Ghana. Yeah, but you're supposed to, that is the law. You're supposed to declare your global income.
Okay, so the whole point is if you're not paying taxes on it, it's not counted as fat. That's what we are trying to say.
Then your economic activity here is not counted, right? It's not known to the state. So we don't know the value that you are adding, the income you are adding. So if you are using the income approach, we don't know there are 10,000 people living in the country, but only 1,000 is paying, we know their income. And that's the tax revenue that we are getting from. Okay, so that is the issue that we have.
Okay, thank you.
And a lot of activities, not just babysitting. In some countries, there may be so many other activities that goes uncounted, and that is where people make the argument about expanding the tax net. Okay, so how do we expand the tax net to bring people in? Okay. All right. Yes, Theophilus' hand is up. Yes. Theophilus can go ahead.
So then per this analogy, then it means that our economy is suffering because most of us don't declare our actual earnings and don't pay the right taxes on the revenues we make.
Even the very rich people in Ghana. Even the very rich people in Ghana, if you ask them about their salary, they will tell you about it's probably just declaring 1/10 of their actual income.
Wow.
Yeah, some of them are even more active in the informal sector than the people in the informal sector. So you see that about 90% of their income is coming from unregistered businesses and all that. So you can't track. You can't track their outputs. So you see that on paper, if you see the salaries people have and the life they live in Ghana, it doesn't add up. It doesn't add up. A lot of activities are not captured, and illegal activities are also not captured.
Okay, thank you, sir.
Welcome. All right, the last dimension, which is also a very important dimension that we need to keep in mind, is the difference between real GDP and nominal GDP. Okay, and as I said, in a lot of budget weeks or election years, this nominal GDP, real GDP, it's misconstrued, and the argument keeps going on. What is real GDP? What is nominal GDP? Why do we say that all the analysis have to be based on real GDP? Okay, nominal GDP, but on real GDP. Okay, so we are economists, so we are a lot of interested. Fine, we want to know the nominal GDP today, but in real terms, how much is it? Okay, so what do we mean by real GDP? Okay, real GDP measures actual physical volumes of economic activity. Okay, follow the definition. I'll work an example and then we come back to the definition. Okay, so we are saying that real GDP measures the actual volumes of economic activity, the output that we are producing. How is this output changing, increasing or like changing in the economy? So that is what we mean. It measures the actual physical volumes of economic activities. we refer to that as GDP at constant prices. Okay, so real GDP means that we are keeping prices constant. Okay, keeping prices constant. I'll explain what we mean by that. And which also means that we exclude changes in prices. We net out changes in prices. We don't capture the effect of changes in prices when we are calculating real GDP. Okay. I know you have questions on that. I'll come back after an example. Nominal GDP, on the other hand, is the CD value of all the economic activities. Okay, and it measures the value of GDP in current prices. Okay, in current CDs. So the value of all the product that we have produced in Ghana, or we produced in Ghana in 2020, what is the value in 2020 prices? Okay. So it's in current prices, while real GDP is in constant prices. Okay. Real GDP, you're keeping prices constant. In real GDP, in nominal GDP, in today's price. So for nominal GDP, we are not keeping prices constant. What is the price today? And times the output you produce today, what is the value, okay, today? Okay. So it includes changes in both physical quantities and prices. So output may be increasing and prices may also be increasing. And then you multiply the two, it gives you your nominal GDP. But in real GDP terms, the focus is more on the physical volumes.
It's okay.
Keeping prices.
You shut your face and
people are enjoying some way. Okay. All right. So nominal GDP is the value of all the economic activities that we have. Okay. The difference between the growth of nominal GDP and real GDP is solely due to changes in prices. Okay. So that is the difference. Okay. So the difference between growth of nominal GDP and real GDP is solely due to changes in prices. What do we mean by all this English? Let's take an example. Assume that the economy of Ghana produces two products. Okay, so our output, what we produce Kelewele and pure water. Okay, so that is what we produce. Okay, so assume the economy produces two items, Kelewele and pure water. How do we compute the GDP from this? Our goal is to compare the GDP between 2010 and that of 2014. So what is the GDP? 2010, 2014. Right. Please try and follow as much as you can. Okay. All right. So the nominal GDP for 2010. 2010, Ghana the economy produced 15 bags of Kelewele and sold each at 10 Ghana cedis. Okay. And produced 50 bags of sachet water and sold each at 2. What is the total amount of money that we made in that year? Okay. So the total GDP or the nominal GDP in that year is 150 from Kelewele and 100 from sachet water, giving us a total GDP of 250. Okay. Come 2014. 2014, the economy produced 20 bags, so more. In the first case, in 2010, we produced 10 bags. But in 2014, produced 20 bags. And we sold each at 15. Okay. Not 10 in 2010, 15. Prices are increasing. And then the economy also produced 60 bags of sachet water and sold each at 2.5. Okay. The nominal GDP for 2014 is 450. 450. If you were doing that old school analysis, you're going to say that, oh, GDP for 2014 has increased so much, it's almost doubling. The economy has, the nominal GDP is 450 million, it's almost 200 million more. Okay. What is the real GDP for 2014? Okay. Keeping 2010 as the base year, the real GDP for 2014 is saying that you take the output that you produce in 2014, but instead of selling it in 2014 price, you sell it in the base year price. You sell it in the 2010 prices for comparison. So for comparison, we are selling the 20 bags of Kelewele in 2010 prices, okay? And that will be 20 times 10, constant price. We are keeping the price constant, okay? So 20 times 10, and then we produce 60 bags in 2014. And we are selling it in 2010 price or calculating it in 2010 price. So a constant price. The real GDP for 2014 is 320. Okay. So the real GDP is 320 and the nominal GDP is 450, but the actual real GDP that you have to be based on, or the analysis have to be based on, is 320 and not 450. So 450 is not the real GDP. Real GDP is 320. Okay. Constant prices. You can step back and look at the definition again. Real GDP is actual physical volumes. We want to know whether output in the economy is increasing, and the income level we are getting is not solely due to price changes. Okay, so the real GDP measures actual physical volumes of economic activities, GDP at constant price. Okay, excludes changes in prices. So we are netting out changes in prices. Nominal GDP, on the other hand, is the city value of the economic activities and measures the value of GDP in current cities. Okay, includes changes in both physical quantities and prices. The difference between growth of nominal GDP and real GDP is solely due to changes in price. Let me just go there and also highlight some implications. Let's say I win an election, come into power in 2014. Okay, I mismanage the economy. Okay, I mismanage the economy. If I mismanage the economy, inflation gets out of hand, prices will increase automatically. Okay. Price increases, and even if output doesn't increase and output even fell from 15 bags to 10 bags, I'll just multiply it by the higher price and to mean that GDP, nominal GDP, is very high. But it's just because of my own inefficiencies. Okay, just because of my own inefficiencies. Whose mic is on? Okay. So then, if I want a higher nominal GDP, I just have to mismanage the economy. I get the inflation to gallop, prices doubles, and output is falling. But I just multiply it to seem as if, oh, Ghana, we have a lot of money in terms of nominal GDP. But in real terms, if you compare the output that you produced in 2014 to a base year price, what is the actual growth in output that the economy experienced? And that is what we are interested in, because as firms produce more, firms are able to expand and then they are able to employ. So the employment effects are driven from the output expansions that these firms are experiencing. If the cumulative seller is producing more, then that seller can employ more people to produce. Okay, so that is why we are focusing on real GDP. Any question? So what is the growth rate? What is the growth in the economic growth? The economic growth, you can calculate the nominal growth in GDP and then the real growth in GDP. So the real growth in GDP will be the difference between the base year GDP and then the real GDP. Okay. So if I was calculating the nominal GDP growth, it will be 450 minus 250. 1 second. 450 minus 250 divided by 250. That will give me the nominal growth in GDP. Okay. So 450 minus 250 over 250, it will seem as if the economy has grown by 80%. But the actual growth, real growth in the economy, is 320 minus 250 over 250. If you do that, it will give you 320 minus 250 over 250. That will give you 28%. So the economy grew by 28% and not the 80% as the real growth. The real growth in the economy is 28%. Okay. Yes, let me take the question. There was a hand. You come back. If I've answered you too, then let me know. Yes, Bismarck.
So please, the network, my network was bad, so I wasn't getting the real and the nominal GDP differences.
Okay, I'll just take a second and go through the table, and then 2 people are recording, so we hope that you can also get a recording. Okay. So we have calculated, I don't know where you ended. The definition is clear. Real GDP measures actual physical volumes of economic activity. Nominal GDP is the CD value of all economic activity in current prices. One is in constant price, the other is in current price prices. In the example, I'm saying that the nominal GDP for each country is, for each year, is selling the product in that year's price. That gives you the nominal. So selling kiloliter in 2010 prices, sachet water in 2010 prices, gives you the nominal. The nominal GDP for 2014 is selling the output produced in 2014 prices, and sachet water also in 2014 price. That gives you the nominal. The real GDP for 2014 is selling the output in 2014 at a constant price, which is the base year price, which is 10. So 20 times 10. And selling the sachet at constant price, the base year price, which is 2. So if you sum that up, that gives you a real GDP of 320. Okay, so the real growth in the economy, therefore, is the difference between the real GDP and the base GDP divided by the base. That gives you the real growth in the economy. So in the example, what is the growth rate of real GDP between 2010 and 2014? The real growth of GDP is 28%. Okay, and the growth in the nominal GDP is this. So you have to be careful you don't go around throwing out the nominal GDP growth and real GDP growth, because the nominal GDP growth is capturing price effects. Okay? It's capturing price changes in the economy, while the real GDP is keeping it at a constant base year price that we can always compare future prices to. In this example, we call 2010 the base year, as the prices from this year are used for calculating changes in real GDP. In Ghana, the real GDP is calculated using 2006 as the base year. So we compare all years to 2016 price. I think it will change it to 2012. I have to double check that. Yes. Nah. Nah, something.
Yes, hi.
Yes.
I understand the table and I mean the definitions and all, but I want to be sure, why do we use the base year? Like, I don't know if the effect is real for the real GDP.
Come again?
Because if we are actually, if for the kilowatt example, if we are actually selling it at 15 cities, why are we using the base year's figure to calculate the real GDP?
So if you want to calculate the real GDP, you want a measure that you can compare GDP to. You don't want an elastic measure, right? So you don't want a case where you compare today's 2011 price to 2021 price to 2020 price, and then to 2019 price. We say that, okay, we have a reference year.
Okay.
Now, from this reference, can we compare the future to this reference year and be able to measure how well we are doing compared to that reference year? So we don't have an elastic measure which changes all the time. So we can say that, okay, it's like you are going to Accra and you're starting from Lagos and you're competing with somebody who is starting from 37. It's an elastic measure, right? So we should all start from Legon, and then we'll see who will get to Accra first. How far you get to, given a reference year. That is why in calculating GDP or calculate a lot of the indicators, we need a reference year from which we can compare the output to. Otherwise, our political people, when I came to power, I got it this, and when you came to power, you did that. But compared to what? Who is the metric? Where is the barometer? Okay, so in calculating this, we always set a base year, and that is what I think we are saying, that in this example that we have, 2010 is set as the base year in our example. Okay, 2010 is set at the base year, and therefore 2021 can be compared to 2010. 2020 can be the growth, the nominal GDP we will get in 2020 2021 or 2022 can be compared to this. And in that case, we will see how real output is changing compared to the base year output, taking out the effect of price changes. Okay, so that is what we do. Sometimes higher prices also affect output because the prices are so high, people are not purchasing, people are not producing. So we net out that effect. Let me see if there is a, yeah, base year, I think it's 2012 or 2013. So it's a reference year that we use. Normally that year has very good data. It doesn't have like economic shocks in that. Okay, so now we know that our GDP for 2020 fell drastically, okay, compared to a reference level. Okay, economic activities during the COVID-19 era, output fell. People were not going to work, so output fell. Prices may be increasing in a COVID era. So if you just multiply output by the increased prices, you may be saying, oh, nominal GDP is still high, but that is not the case. It's real GDP that you are interested in. All right, class rep, tell me when time is up. If you leave me, I'll be talking for the whole day. Okay, how many minutes do we have? I moved the class time 1 hour forward, so it's the rep here, and I have 7. Okay, let me take Nanaya.
Good afternoon, sir.
Good afternoon, Nana.
Please, what is GDP Deflator?
I'm coming to it.
Somewhere. Oh, okay, thank you.
Oh, you want me to leave it for you?
No, sir.
Okay.
Sir.
Let me, yes.
Sir, please, your time is up, but it looks like the class, yeah, we are enjoying your lecture. So
So it's in your hands. If you want me to go, I can.
Sir, then please ask them if they still want to enjoy the
Sir,
lecture.
please continue.
Sir, please, you can continue.
Sir, the request of the people.
Yes, please, let's do 7 more minutes so that we can finish and
okay, let's get. You tell me when you guys are. You guys are. I know people. Trust me, people. When is your exam? Somebody's asking me areas already.
Yes, please. I think this is the last lecture period timetable, and we are beginning the exams next week, Saturday.
Next week, Saturday.
Yes.
Okay.
The on the 17th.
The conference is on the 17th.
Yes, please.
17th of April.
Yes.
All right. The class rep. Who's the rep again? Let me check the name. Andrews, please call me. I was looking for your number today. Please, kindly call me.
Please.
And then if there's anything I have to do extra, then I can liaise with you. Okay.
Okay, please.
Thank you, Doc.
Thank you so
All
much.
right. Okay, so price index. Maybe we can just go into that. Remember, there was one of the sessions that I repeated. I think the beginning when people didn't understand. So there may be an extra that I have to finish up. All right, GDP deflator, pricing indices. Prices are very important in an economy. Okay, I like the market women a lot. They know how to talk about price. They say, "Oh, things are hard." Okay, so and it means that the cost of items have increased. Okay, the general price level in the economy has increased. So a price index is a measure of the average level of prices for a specific set of goods and services relative to the price in a specific base year. It's a consuming economy, okay, to improve our well-being. So I can say, if you assume that this is our basket, a lot of things will go into that basket. So the things we consume, fuel price. So the fuel will be in textbooks, books. Yes, Andrew.
So please, it seems your network wasn't stable, so we didn't get the definition.
Okay, sorry, it's University of Ghana internet. Okay. Price index is a measure of the average level of prices for a specific set of goods and services in the economy relative to the price in the whiteboard. And I'm saying that typically a country has the number of goods usually will buy. So for Ghana, we can have, say, the fuel will be in our basket, price of cassava, price of plantain, pepper, the things that we normally will buy. As gas, now we have to add data. So the prices of things that we normally, specific goods that we buy, textbooks, cost of tuition, all manner of things will be in this basket. So what we would do, or typically is done, is to track how the prices in this basket is changing over time. Okay, how this price is changing, and then we compute a price level for the average price level for the average price for the basket. Okay, so let's say the average price for the basket is 100. Okay, and let's say that this is the basket, the price in, say, March. Okay, the cost of the basket, the average price level is 100 in March. Come April or the next month, if you are doing month on month, you can do another, can go around again and check the prices of the same items. Okay, again, okay. You go to this. Normally, they are satellite or reference markets that they will go and check how the SASCA service will do that, collecting the data on the prices. Okay. And then compute the price level again. So let's say the price level is 120 come April. The price levels helps us to calculate the inflation rate. Okay, so the inflation rate basically will be the difference between the price levels. Okay, how the cost of the basket has changed over the period. So this will be like month-on-month inflation. Okay, you can also do year-on-year inflation where you can compare across years. So this will be month-on-month. And if you go by this example, that means the price of the basket has increased by 20%. Okay, so that will give us the inflation rate. So the price index helps us to calculate the inflation rate. It gives us an idea the cost of the baskets or the cost of the things that we typically will consume in the economy over time. Okay, so that is the general idea behind the price index. But we have different indices, price index in the market that we can use. We can have the consumer price index, we can have the producer price index, and then we have the GDP deflator. So GDP deflator is an example of a price index. Okay, so we'll talk first about the GDP deflator, and then we'll talk about the consumer price index. Okay, the GDP deflator is a price index that measures the overall level of prices of goods and services included in the GDP calculation. Okay, so it's basically capturing the price of the things that we have in our that we produce. Okay, that is goods and services that we produce or in the country, or that goes into calculating our GDP per capita, calculating our GDP. So the GDP that is the deflator, and the deflator is calculated as the GDP deflator is the nominal GDP, so GDP nominal over GDP real, okay, times 100. So the nominal GDP divided by the real GDP will give us the GDP deflator. So in our example before, where we have the real GDP and nominal GDP for 2014, we can calculate the GDP deflator for 2014, which will be the nominal GDP divided by the real GDP, which helps us to capture the extent to which the prices in our that are used for calculating our GDP, the price of the product that we produce, how the price levels have changed over time. Okay, so in our example, the GDP deflator will be 450 divided by 320, which is the nominal GDP, over the real GDP times 100, which gives us 140.6. That gives us the deflator. Okay. So if we know the deflator in the base year price, and the base year will normally have a deflator of 100 because the reference year. Okay. Because if you use the base year, the nominal GDP and the real GDP is the same in the base year. So the difference will give us the inflation. Okay, so that is the deflator. The deflator here is the nominal GDP divided by the real GDP. If you are asked to calculate GDP deflator for a particular year, is the nominal GDP divided by the real GDP. Okay. However, for inflation calculations for lots of countries, because the price level, the inflation captures the cost of living to some extent, the price index that is used is the consumer price index. How the prices of the goods and services that people consume in the economy is changing. That is what we use, because the deflator, the GDP, the things that we produce in this country, not all is consumed in that state anyway. So if you have cocoa and other things, if you capture the price of cocoa as a measure of the cost of living in Ghana, maybe it may not be the right way to go. But if in the basket you are using the consumer items that people buy, then it gives you a good indicator of how the cost of living in the country is changing. Okay. So the GDP deflator can be used for calculating inflation. Consumer price index is a more common measure of inflation. Okay. So CPI is a more common measure of inflation. The CPI is a price index of consumer goods. Okay. It contains a fixed typical market basket of goods and services, but sometimes you can review it as the preferences of people in the economy changes. Okay. 20 years ago, you probably will not add data, gas, or something, but now it's part of the goods. So the fixed typical market basket of goods, and that is the one that I showed you on the market basket of goods and services that we consume. Okay. I hope you guys can hear me. Okay. So we said that we use the CPI split inflation, okay, as follows. Okay. And here it's the inflation is denoted by pi. Okay. Pi is the inflation, And if I say pi t plus 1, it means t is the current period. Okay, plus 1 will be one year extra, so the future. So if I have pi t being t is 2021, then t plus 1 will be 2022. So inflation in 2022. What will be inflation in 2022? Inflation in 2022 will be which is PT plus 1 minus the price level in 2021, okay, divided by the price level in 2021. Okay. So in the example that we have, this, don't memorize these things. It's just understanding that the inflation that we have, okay, let me do that. Inflation here, which is pi, I don't have the pi symbol, okay. Inflation that we have here is the difference in the price level, okay. So the consumer price, the index, the difference in the CPI 2021 minus CPI 2020. Let me drag this a little bit. Okay. Divided by CPI 2020. Okay, that gives you inflation rate for 2021. Okay, so CPI price index 2020, that will give you the CPI CPI, but inflation for 2021. Okay, that gives you the inflation for 2021. What will be the inflation for 2020 or year-on-year inflation for 2020? The year-on-year inflation for 2020, inflation 2020. By now, I'm sure it should be clear to you that it will be the CPI for 2020 minus that of CPI 2019. Okay. All divided by CPI 2019. CPI 2019. Okay. So the current period, the period that you are looking at minus the previous divided by the previous will give you that index. Okay. So that is the general equation that we have for the inflation, the difference in the price index. So we use the CPI, the price index, to calculate inflation. I'll revisit this in a jiffy, so you see how we go about that. Okay. Let me see how far I have to go. Okay. Okay, let me finish this section and then the classwork and I can talk later. All right, let me relate that. That is, will give you the inflation. Let me relate that to raw interest rate and nominal interest rate, and then we can close. Okay. Okay. So real versus nominal. So we talk about real GDP and then nominal GDP. Interest rate also, you have real rate and nominal interest rate. Okay. What is the difference between real and nominal interest rates? Anybody? Real interest rates and nominal interest rates. Okay, since I don't have time, let me just go through that. We say that we derive, I'll come to the definition. We say that we derive the real interest rate from the nominal interest rate by adjusting for the rate of inflation. Okay, so let me go back. Let me take this and then explain on the whiteboard. Okay. 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 So remember that the P here is the inflation. Okay. It's rho equals to nominal I over inflation minus inflation. Is a pi. Inflation. Oh, what am I doing? Capital. Okay. All right. What is the real interest rate? And we are saying that R here is the real interest rate, I is nominal interest rate. Okay. Let's say I gave you a loan of 100 Ghana cedis. Today, you are paying me back that money in a year's time. If you, in the future, if you give me back 100 Ghana cedis, in a high inflation environment, my money would have lost value. Okay. So if the bank, if you are going to take a loan from the bank will give you a rate adjusting for inflation and sometimes adjusting for the riskiness of that borrower. So here I'm just adjusting for inflation. Okay. So if I'm a bank, the nominal interest rate is the rates that you are getting today. So if you go to the bank and you get, say, interest rate of 30%, which is the nominal interest rate that you are getting. The banks did set this 30% based on their expectation regarding inflation. Okay, so I'm expecting that by the time you pay me, how have prices in the economy increased? So that if you give me back the money, I wouldn't make a loss on it. So the bank adjusts for inflation. It means that if they charge you 30%, the real interest from their side the real interest from their side will be 20%, or put in a different way, the real profit, the profit they will make on giving you this loan, which will be the real interest that they are getting, is 20%. Okay. What happens if the bank was expecting a 10% inflation? So the bank was expecting, say, a 10% inflation, 10%. But inflation was, the end of year inflation ended up being 20%. It means that they have already given you the loan at 30%. They were expecting a 10% inflation so that they can make a real profit of 20% or real interest of 20%. But it happens that maybe something happened in the economy, we didn't manage well, inflation got out of hand, and it's 20%. Means their real interest is 10%. So you find that a lot of financial institutions will get people who help them single digit inflation. Because when people expect higher inflation in the economy, interest rates will rise. Nominal interest rates will rise. I will rise. If I'm expecting that, expecting 10% and it ended up being 20%, and then I took a loss because I gave the loan at a reduced rate. Next year, if I'm giving out a loan and government says that I'm expecting a 10%, I'm expecting a 10% inflation, and I'm the financial institution, I would even expect a 30%. I will expect a 30%. And if I expect a 30% inflation, what do you think will be the nominal interest rate I will charge? Okay. If I'm expecting inflation to be 30% in the economy, and if I'm giving you a loan, at least I will charge you 30%. If I don't want to, if I want real interest rate of 0%, then I'll charge you at least 30%. But I also want to make profit. So then I charge you 40%. That 30% goes to account for inflation, and then I can still make a profit of 10%. Okay. So inflation expectation is very important in any economy. Okay. When people expect higher inflation, inflation will indeed be high, and therefore interest rates will also be very high. Nominal interest rate, the interest rate that you get today, which is a nominal interest rate, will be very high in the economy. So government will always say, okay, I'm pushing for single digits. Okay. If government is pushing for single digit inflation, so say 5% inflation, then if I'm a bank and I want to make a real interest of 10%, I want to make a real interest of 10% on the loans that I give, then I don't have to charge you so much. Then I charge you 15% in nominal interest rates, and then 5% goes to defray inflation costs, and then I get my 10%. Okay. If government is targeting 15% inflation or 10% inflation, 9% inflation, and I believe the government, and I want only 5% profits on the money that I'm given, then I just charge 14%. Okay. So I charge 14%, and I realize this, my 5%. Okay. So you can already see in countries where inflation is very low inflation, like you go to some countries, the $1 shops, everything is still $1. Okay, after 5-10 years, it's still $1. The prices haven't increased so much. The interest rates, nominal interest rates are very low, inflation is close to 1%. Interest rates are close to 2%. Okay, so people have, say, let me close on that. So inflation is 1% inflation. Banks are not making huge money on that. Then they just charge 2% nominal interest rates. So the money they are only making about 1% on that. Okay. So they make 1% on that. on this. So nominal interest rates are 2% in certain countries, even some countries close to 1%. Okay. Or as somebody was saying, interest rates. Okay, so it's about 2%. Because inflation, the value of the dollar is the same. Then I don't have to. The cost of things are not so expensive. The same. Then I don't have to charge a higher interest to defray inflation. But in high inflation environment, in 20% inflation, nominal interest rates will be very, very high. All right, let me end here for today's class. Those who are recording, both Andrews and Theophilus, please make the recording available to the class. I will talk to the class rep, and if there's any information, he will get back to the class regarding that. Okay. The assignment that was shared on Sakai is due on the 9th of April. Yes, so it's a second assignment for the class. So please make sure you submit. It's due on the 9th. Do the assignment and understand the assignment, please. Okay. As I said in the bigger class, this is graduate school. This is not where you want to be first. This is where you network. Okay, so form groups, discussion groups, and then form discussion groups, and then solve some of the questions, but understand. Okay, don't just submit anything. Understand before you submit. Okay. The mode of the exams for, is the timetable not out? I think we decided for this economics. The class rep.
Yes, please, it's out.
I think it's in person.
Yeah,
right?
Yes, please. It's on the 17th of April.
Yes, it's in person.
Saturday, 8 a.m.
Yeah, Saturday morning, 8 a.m. So please take a look. Solve as many questions as you can get. Do both assignments, do them and understand. I've taught this course enough to know that somebody gets 100 on the assignments, and in the final, the same question comes, and the person is struggling. My EMB students will say, "Oh, doc, if they're in the final, it's still 1.5 people." If it's 1.5 and it turns to 1.6, then please more than 1. What does it mean? Okay, so don't learn it like robotically. Try and understand it 5. So do the assignments. The exams will take a format like the assignments that you are doing. So try and understand them and go through them. Have discussion group, form groups, and solve the questions. You'll be fine. Okay. All right, class rep, please. Let's talk either later today or tomorrow.
Okay, please.
Have yourselves a nice day. See you soon.
All right.
Bye-bye.